The S&P 500 has averaged about 10% a year over the past 100 years, and that would be a truly impressive return for most investors. But Peter Lynch, he's not most investors. He led the best performing mutual fund in the world from 1977 to 1990, earning an average annual return of, get this, 29%. So what were the secrets to his success, and what can you learn from them? Let's take a dive inside the mind of one of the top investors of all time. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. And on today's show, we're exploring the work of one of the all-time investing greats. A veteran portfolio manager is going to share his take on some of the top investing lessons he's learned from Peter Lynch, and how you can apply them to your own portfolio. Plus, we're going to take your questions on all things investing in our live Q&A session later in the show, so stay tuned for that. Let's get things started. Joining us is Charles Edgar Martin, Senior Portfolio Manager at TD Wealth. He has over 30 years of experience in investment management, and now he leads his own team serving affluent and institutional investors. Charles, welcome back to the show. It's always a pleasure to talk to you. Thanks for taking the time.
Thanks, Robert. Good to be back.
We had you last time talking about some of your top investing takeaways from Warren Buffett and Charlie Munger here. Glad to get your take on Lynch here. Maybe just to kick things off, give us a sense, what do you think made Lynch so successful as an investor?
Well, a bunch of things. For me, if I think back to when I started in the industry way back in 1993, I couldn't get a job as an investment advisor. So I got a job cold calling. What a horrific period that was. But I was trying to get my knowledge up, and I read a lot about Peter Lynch and Warren Buffett. And a lot of the concepts that I'm using now are definitely come from the readings of, One Up on Wall Street and Beating the Street way back when. And the one thing I would say that I remember from Peter Lynch, if I had to pick one, is he was very good at finding what he called 10 baggers. Companies that would their stocks would go up 10 times. He was very good at finding them, which a lot of us are good at doing, but he was particularly good at keeping them till they became 10 baggers. Whereas a lot of us will find these companies, invest in them, and take profits after 20 or 30%. So I remember that if you can find 10 baggers and hang on to them long enough, it can really make a huge difference in your portfolio.
Yeah, no shortage of wisdom from Peter Lynch here, and we're going to get to a lot of quotes here. We got a lot to get to, so I want to get down to it. Let's get into the heart of our conversation, okay? Those investing lessons that you learned from Peter Lynch. And for those in our audience, if you want to get in on the conversation, you can make sure to submit your questions to us, okay? If you're watching on Webbroker, use the chat box. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, there's a link in the description. Just click on that. It'll take you over to our broadcast platform, and that's where you can ask your questions to Charles. Okay, Charles, our first quote here from Peter Lynch that we're going to cover here is, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Now, if you ask my wife, not about investing, just about in life in general, I'm not even right 6 times out of 10 here. But what's your take on what Lynch is trying to convey to investors here with this quote?
I like your wife anecdote. It's very good. I think for me, that was pretty interesting when I first read it, because I've never known an investor who is looking at a company, including myself, and who says, this one's probably one of the ones that's not going to work out. Let's buy it. Right? So every time I buy a new investment, and I suspect everyone buys a new investment, we are convinced that this is going to be a great investment for us. Yet 6 times out of 10, these aren't hugely favorable odds. So that really marked me early in my career. And quite frankly, I didn't really believe it until I lived it. And I think knowing that going in is extremely helpful. If you know that, of course, you're buying a company or investment because you are convinced it's going to work out extremely well, but there's a 40% chance that you're wrong, I think you owe it to yourself and to your clients, in my case, to look at what could go wrong with this story. and then keep an eye out for that and play devil's advocate. And you've heard me talk about this quite a bit. I think as I have more experience in this industry and with the business of investing, that's one of the things that's made me a better investor. Just knowing that those odds they're not as strong as we tend to think they are. I think we tend to have a cognitive bias to be much too optimistic with our investment choices. And then we have a bias to being very pessimistic on news. And we'll probably talk about that a little bit later on in the conversation today.
I'm wondering if there's an example that you can give where you had to sort of reason through the potential upside and downside of an investment that you had made in the past that you could share with us that kind of illustrates this need to try to take an unbiased approach and try to not get reading your own headlines and buying into your own hype as a stock picker.
So sure, I'll tell you about one that comes to mind right now is Visa. We all know the company Visa, and many years ago, I bought Visa in 2012, if I remember correctly, so a long time ago. And Visa, for me, really is a Peter Lynch type of company. It's the kind of company that I knew that it had grown quite a bit over the past. And I suspected that the growth potential could continue for really quite a long time. So it did have, in my opinion, the potential to become a potential 10-bagger. Which Lynch is very clear about. He likes to buy companies where he really sees that, the growth isn't just going to be for the next 12 months. It could go for 5, 10, 15 foreseeable future amount of years. So Visa definitely fit that bill. My feeling, just to oversimplify it, is that as there is a smaller proportion, or let's just say a bigger and bigger proportion of the world population goes from poor to middle class, one of the first things that you do when you become middle class is you get credit. You get a credit card. And there's been this trend towards more and more people going from poor to middle class worldwide. I felt that Visa could definitely profit from this long entrenched trend that I felt was going to continue. So there's the positive. There's the reason why I knew I was going to be right on Visa. But I forced myself to look at what could go wrong. And what could go wrong, there were a few. First of all, valuation was not inexpensive. And Peter Lynch definitely talks about paying attention to valuation. It's okay to pay a little bit of an expensive price for a company that is much above average, but you can buy a great company at a terrible price and not do well at all. So the valuation was a challenge. It was a little bit rich, and I ultimately decided to buy, so I felt it wasn't too rich. And another, one of the prominent risks that I saw was that companies are more and more, or let's just say less and less happy to pay those fees to Visa. And I believe there's a pressure on governments to pressure those fees. And governments are omnipotent, right? So I felt this is what could go wrong with the situation. So I'll just keep an eye on that potential danger. And if that potential danger becomes more present, maybe that's going to be my reason to cash out. So far, I've held it for the 13 years or so, and it's been a great investment. But I am very aware of what could go wrong, in my opinion, with that story. And what's gone right has gone right, thankfully.
Okay, so Lynch advising people to, check their own enthusiasm and their own pessimism too on the other side of things here. The other thing that I took from that quote was that diversification is really important. It's been called the only free lunch in investing here. And if you're going to be wrong, however many times it is out of 10, you want to kind of buttress yourself here a little bit with multiple positions here. I'm curious, for a DIY investor then, how much diversification generally makes sense for an everyday stock portfolio, let's say?
So this is all opinion right here, right? Because there is no mathematical correct on that, although you could do correlations and so on and try to figure out a number. I remember in school way back, they said somewhere between 12 and 15 companies in different industries would give you, let's just say, adequate or substantial diversification so that any one company could not hurt you too much. And again, too much is a very subjective term. And if you had more than 15, substantially more than 15, you would become closer and closer to the market. So if your goal was to be better than average with some kind of protection for those 4 out of 10 that'll be wrong, 12 to 15 is something I've stuck to. And as what I've learned, personally, I'm 15 to 20 is what I do in my Canadian portfolio, and 15 to 20 US. And a little anecdote, which is kind of funny. Another thing that I remember reading from Peter Lynch is he had over 1,000 stocks in his Magellan fund at one point, which is unbelievable because Peter Lynch also believed that you should really understand all your companies. And I thought, how can any one person have the brain power to follow that many companies? And he did. It's kind of a contradiction because I believe he's the one who coined the term diversification. Basically, he stated in his books that you can be over-diversified, and when you're over-diversified, there's no point. Yet he held over 1,000 stocks. I think he held over 1,000 stocks because his fund had become so popular. He had so much money to manage that he just he had to have a lot of companies because he was too big an owner of some of the companies that he preferred. But he definitely, I remember the word diversification from Peter Lynch. I agree with that. 15 to 20 in one market is the range that I stick with.
Okay, so a nice little rule of thumb for folks to keep in mind here. I want to move on to
Robert, I'm sorry. I'm going to interrupt you.
Sure.
Because I believe I have to put this in because I've seen it on a lot of DIY investors' statements. 15 to 20 doesn't mean 15 to 20 banks, right?
Yeah.
So different industries. I don't know how many portfolios, especially in Canada, where our banks have done really well for very long, but owning 5 banks is not a diversified portfolio. It's slightly better than owning one bank, right? So when I say 15 to 20, I mean different industries, or else you're a lot less diversified than you think you are.
Yeah, certainly. And also geographies too is another thing to keep in mind here. Let's move along to our second quote from Peter Lynch here. This one goes, remember, things are never clear until it's too late. Charles, what are you taking from this quote?
Well, I think there's an element of risk taking when you are investing in stocks. There are no sure things. He talked about 4 out of 10 being wrong. So you have to be aware that you will be wrong often. I think it's clear that when we look back at some of the ideas that have failed, we say, well, how could anyone have made that silly decision? But when you don't have the benefit of hindsight and you're looking forward, nothing is really clear. Having lived through the great financial crisis of 2008, 2009, movies come out how it was obvious. There were hints, but there weren't that many people saying it's obvious that this will happen. It really became clear after the fact. And I think Hollywood embellished a little bit of those stories. So I think Buffett also said that you don't drive by looking at your rearview mirror, right? Because you're going to hit something. I think it's important to have an idea what's happened behind you. So if I go back to my Visa example, to have seen the consistent growth in sales, in revenue, in profits, in cash flow for many years of Visa demonstrated that they were on a trend towards growth. But when I was buying the stock in 2012, the past was not relevant. The future was. If their growth was to stop in 2012, I would have made a very bad investment. So I had to project what the future would look like. And that's an imperfect art. It's not a science. So there's an element of risk taking, and you have to do your best to predict the future. And the ones who are the best at predicting the future will have the best results. I also read into that quote that because there's so much risk in predicting the future, you really want to go in something where the future is extremely hard to predict? Or do you want to go into a company or an industry where the future is quite foreseeable? I think in an ideal world, you want the investment where the future is as easy to predict as is possible. So if you're in a company that has very little competition and very high barriers to entry, in an industry which is clearly there's huge demand and increasing demand, that's much more interesting than a company that has several competitors, many new competitors just waiting to get in an industry where we think it'll grow, right? It's kind of obvious, but I think you want to increase the certainty in an uncertain world.
Yeah, and certainly there's been a lot of uncertainty for investors to contend with these days with this tariff war that the Trump administration is waging here. But to Lynch's point here, you do need to take some risk as an investor, of course. And speaking of that, I kind of want to get onto a third quote here from him. This one goes, focus on the companies, not on the stocks. Now, this one kind of might sound counterintuitive to someone first reading this because, hey, companies are stocks, stocks are companies, right? So what is Lynch getting at here, Charles?
My interpretation of that, I love that quote. I think it's amazing. I mean, 31 years later, I still use it with clients and I still remind myself of that. I see a lot of people buying a stock because their friend said it was going to go up. But I've never seen an entrepreneur buy a company because his friend said the company was going to go up. I've never seen an entrepreneur buy a company because the valuation dropped to its 30-day moving average. And that would mean that the valuation would climb. I've never seen, there's a lot of things that stock investors do that investors would never do, entrepreneurs would never do. So I think he's saying, think like an entrepreneur buying a private company. He was a believer in, or is a believer in fundamental investing. So he believes that you're buying these companies based on fundamental valuation, which has nothing to do with a lot of things I just mentioned. Entrepreneurial investors would never buy, I don't think would ever buy a company without looking at the balance sheet. What does this company owe? Can they pay that back? I wouldn't buy a private company without knowing that. So why would I buy a stock that way? So I think he's saying, have the discipline to buy a stock as if you are buying the entire company privately. And once you own it, be aware of the risks, what could go wrong. But if a recession comes, usually that's not a reason to sell a company, because if you bought a company, I would hope that you considered the possibility that recessions are cyclical and they happen regularly, and you shouldn't be selling on your predicted timing of a recession because you're not going to be good at predicting when the recession will come. So you're buying a private company knowing that you will hold it through the next recession. So if you're doing that, the next time a recession comes and you've made a wise choice, the risk of a recession coming is not really a good reason for selling your stock. According to Peter Lynch, that's my interpretation of what he's saying there. I agree with that, by the way.
Yeah, and to not necessarily get distracted at short-term fluctuations. If you're buying a company as an investment, certainly what happens today might not necessarily be important to you if you're intending to hold for a period of time here. And speaking of that, I'm wondering if you can share an example of us when you focus on the fundamentals rather than these temporary stock price drops and fluctuations and stuff like that, and it helped you ultimately stick with a great company even when things weren't necessarily looking great at the time.
So before I get on to that, something to add to the last question or last answer to the last question. I have a friend who once told someone, he bought an investment for him, and a couple months later, the client said, well, it's down. And he came up with a quote that I thought was great. He said, when you plant your carrots, you don't pull them up every day to see if they've grown. That would just be silly. So I always remembered that metaphor. I think it's relevant for the type of investing I do, and I think the way Peter Lynch thought. So to give you a company that I'm thinking of right now, which I own and I really like a lot, but the price performance certainly hasn't given me reason to own it. It's CP, the railway, obviously very well known Canadian, international railway company, and really over the last 3 years, it's a flat line. It hasn't been a good investment in the last 3 years, but I know why I bought CP. I understood that in periods where risk of recession is high, CP is a cyclical company, so typically shipments by everything go down when there are recessions. And typically when the risk of recession is perceived to be high, stocks being forward indicators, leading indicators, cyclical stocks will perform poorly, typically when a risk of recession is deemed to be high. So we had a very high risk of recession in 2022 with interest rates going from 0 to 5 in no time. The risk of recession was very high. That risk dissipated this year. Then the tariff war came on. Risk of recession comes back to being quite high. So if you had told me that before I bought CP, I would have predicted that CP would probably not be my best performing investment in that kind of scenario. So I believe that the economy is cyclical. I believe that the risk of recession will come and go, that historically recessions last about 11 months and the growth periods last 6 to 7 years on average. I believe that that pattern will somewhat continue. Maybe not 7 years to one, maybe it will be 3 to 1 or 8 to 1, something like that. So I believe that there will be more good years than bad years for CP. And I believe that the right thing to do is to be patient with CP right now, because in this kind of environment, I think it's difficult for that stock to do well. So that's an example for me where the fundamentals and understanding the company as I do doesn't stress me at all to see that it has not gone up in 3 years in this kind of scenario.
Fantastic example that leans on the fundamentals and the importance of them here. On that note, Charles, I just want to take a quick break in our conversation here. I want to bring in our colleague, Caitlin Cormier. She's going to show us how Webroker can help investors research the fundamentals we were just mentioning here. Caitlin, welcome to the show.
Hey, Rob. Glad to be here.
So take us through it here. What are some of the ways that investors can go and find some of these fundamental metrics that Charles and I were just talking about to consider when they're evaluating a stock?
Yeah, absolutely. So Webroker can definitely provide lots of financial information on companies like what we've been discussing so far in the show. So let's go ahead and hop in under our research tab in Webroker. So we're going to go under research, and then we're going to come over under investments and click on whichever, obviously we're talking about stocks today. So we'll go ahead into stocks. Then you're going to notice within the page on the bottom right-hand side, there are some fundamentals. So our market capitalization, a bit of dividend information, a few ratios, and also the earnings kind of calendar to give you an idea of what that looks like. But if you're looking to dive even deeper and really get into kind of the nuts and bolts, then you want to come up here and click on the tab that says fundamentals. So this is where you're going to see a more in-depth look at the financials of the company. So we can see here there is information. This is an industry average comparison. So it's taking one individual company and comparing it against the industry average and giving it a ranking within that industry. So you can kind of scroll through and see different metrics and how this company compares to the average. We can also come up to the peer comparison, which is actually going to show us against similar companies. So whatever is considered to be a peer for this particular company, you're going to be able to see that side by side, similar sort of information, so all the different ratios. And then finally, of course, the financial statements. So the third tab here is the financial statements. You can see both the annualized and the interim statements. And you'll notice it gives you kind of a bit of a graph here of each of the three statements, so income statement, balance sheet, and cash flow statement. And then if you want to go, so right now we're on the income statement and we can kind of drop down and see some year-over-year performance. Or we can click on a different sheet, and again, that will bring up the additional information for those other financial statements. So quite a bit of information that you can get just by coming in under the fundamentals tab on Webroker, so you can do a bit more research on these companies.
Yeah, thanks for showing us that, Caitlin. It's a really nice place where you can get a snapshot of some metrics, but also you can get the nitty gritty and dive deep when you want to. Appreciate you taking us through that. And hang tight. We're going to be back with you a little bit later in the show here. Got a friendly competition with Charles coming up here, so stay tuned for that, everyone. That's our senior client education instructor, Caitlin Cormier. Okay, Charles, back to our conversation, investing lessons of Peter Lynch here. I really like this fourth quote from Lynch, and I'm curious to get your thoughts on it here, okay? It goes like this: go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it. Charles, what's your take on this one?
I love that one. So quotable, eh? So quotable. I wish I could come up with great.
It's quite the wordsmith. I agree.
Yeah. So that one also marked me, and it's something that I practice a lot. So it goes back. A lot of things for me go back to some of the initial quotes that you brought up, like the wrong 4 out of 10 times. So if we know we're going to be wrong 4 out of 10 times, we want to minimize the damage. If you're buying a very complicated company that's extremely difficult to run, well, naturally, the odds of running it properly are much lower, right? So we want to put our investments in things that have the highest probability of working out, and also in investments where if we get it wrong, we're going to limit the damages. This, I think, is pretty important. Another thing that Lynch has talked about a lot is you should know what you're buying, understand the company. And if you don't understand it, you shouldn't be investing in it. Because I think a lot of people buy companies just because it kind of sounds sexy, or it's the fashion, and it sounds, techie and new and stuff. And I mean, you really have to understand what the product is, and is the product good? And if the product is good, the simpler it is, the simpler the company is to manage, the greater the odds that the company will achieve what we're asking for it to achieve in order to give us the adequate rates of return. So for me, give me 2 investments, one that I think will make X percent, another one that will make maybe a little bit more, but the first one is much higher probability of making that positive rate of return. And the other one is an extremely complicated company, very difficult to manage. I mean, for me, it's pretty obvious. You want to go with the one that's more certain. So I think that's what he's getting at there. Companies that are easier to manage have a higher probability of being profitable investments, and companies that are difficult to manage, when you think about it, you don't have to think about it very long, have a higher probability of not working out. So harder to manage.
That's right. Remove as many unknowns and complications as you can, and hopefully you can get a better result out of it here. It actually kind of reminds me of this 5th quote then from Lynch as well that I wanted to get your take on. And it goes, if the stock is grossly overpriced, even if everything else goes right, you won't make any money. And you actually kind of teased this a little bit earlier in our conversation, Charles. Talk to us about what you think he's getting at here. Why is it so important that focusing on the company itself rather than the stock price, on the one hand, is really valuable, but then on the flip side, you have to be very cognizant of what you're paying for the company and its stock price when you go to make that investment?
So I started as an investment advisor in September 1994. That's when I was a young guy, and I was pretty advanced because I had seen the internet with my own eyes. Most people who were investing had never seen it. And I received an email shortly thereafter, and no one I knew in my office had ever received an email. So needless to say, this is hard for you young people to relate to. But in the late 90s, there was a tech boom, and anything that was called .com or technology or fiber optic went up because the concept, we all had the dream of, they said, one day everyone's going to have the internet at work, and we might even have it at home. So obviously anything that's related to these companies will do well. And history's shown us that, there was the tech boom peaked, I believe, in March 2000. And if I remember correctly, it took something like 15 to 17 years for tech companies to recover, which is pretty incredible because there was a lot of progress. I think you've got the chart of Microsoft there. It's one that I often refer to. Microsoft was not the most avant-garde, dangerous .com type company, right? This was a real company with real profits and a real product that most of us were using every day. Word and Excel, we're all using that every day. And they did well. Their profits, I believe, quadrupled between 2000 and 2016 or something. But look at that stock price. If you bought at the height of the folly, you paid such a high price that this company managed to quadruple its profits in 15, 17 years, something like that, and the stock was still down. Imagine being in the red for 15 years with a company that's delivering, its profits are increasing. So when people say, to invest in stocks, you have to be a long-term investor, I don't think people think, I'll be in the red 15 years. I don't think they consider that as a possibility. It is a possibility. And the problem there Microsoft was not the only one. There's several, Cisco, Walmart even, companies that were trading at such high valuations that the price couldn't justify the earnings growth, and ultimately they were losing investments, although the companies were still growing. So that was early-ish in my career, so I really learned that lesson, that it's not just about buying, shiny things that look great, they're going to do great. The price you pay is extremely important, and if you overpay, you could have something that gives you 0 to negative for a really, really, really long time. And we're not running money for hundreds of years. Most investors start, they've paid their mortgage, they start investing. They can't wait 30 years for their investment to give them an adequate rate of return over the 30-year period. So price you pay relative to the company is extremely important. You could buy a great company, great industry, the company delivers, and the stock does poorly because you looked at it as a stock, not as a company.
Yeah, it sounds like the important thing here is be very cognizant of what the stock is doing and the price that you'd pay when you go to buy it. But then after that, focus on the fundamentals. Don't necessarily get caught up in the stock fluctuations here. One thing on the metrics point of view is I think a lot of people can intuitively understand like what you're talking about there and what Lynch is trying to convey. But what are some of the metrics that you're using to try to figure out a fair price to pay for a company?
So Lynch, he was the first one that I ever heard who talked about PEG ratios. Price earnings to growth. So most investors will be familiar with the price earnings ratio. And I kind of like to look at it inverted. So the earnings divided by the price, and it gives me kind of a percentage, right? If a company is at $100 and they make $2 in profits, well, it's 2% earnings yield, or it's 50 times earnings. For me, 50 times earnings is kind of an arbitrary number. But when I say that company's giving me, for my $100, I will get 2% in profits, that gives me an idea of what I'm paying. And normally, I'd say, well, 2%, I could probably buy a GIC that would beat that and with no risk. So I have to be either extremely certain that those profits will persist, so a very, very stable company, or I have to believe that the upside is great enough to make up for the fact that I'm getting, I might be getting pretty poor return. On the other hand, if I'm buying a company at 20 times earnings, well, 1 divided by 20, is 5%, right? So I'm getting a good rate of return in today's world, right? Relative to what I could get in a risk-free or safe investment. So that makes sense to me. So the earnings yield is really important compared to what is the risk-free rate. You could use the GIC rate as an idea of what the risk-free rate. You want to be compensated for taking risk, right? So you want a higher expected rate of return. And you would, if the company is growing its profits at 20% a year, well, you'd be willing to accept a lower earnings yield because those earnings will grow faster than a company that was growing its profits at 5% a year. So you would say my earnings yield will increase over time and get me way over that hurdle rate of the GIC rate. So I think to keep it kind of simple, I think we want to look at the earnings yield relative to the growth rate and relative to GICs or the risk-free rate. Those are some of the things we want to look at. For growth, I like to look at historical growth. Ultimately, what counts to us is the earnings per share. But the further down an income statement you go, the more manipulation of the numbers there is. And a lot of that manipulation is legal manipulation. So the higher up an income statement you are, the more certain, in my opinion, you are that that number is true. So I like to see revenue growth. It's harder to let's say, manipulate the revenue number than it is the earnings number. And if I have revenue growing, going back to a company that's run by a fool, right? If I own a company where the demand is increasing and the revenue is going up every year, it's not so hard for me to make the profits go up. If the revenue is not going up, well, then I have to become a really good manager. I have to cut costs every year to make those earnings go up, and that's that's finite. I can't cut costs below zero. So at one point, I'll run out of things that I can cut. So revenue growth is a good indicator of potential earnings growth. You want to look at earnings yield or price to earnings relative to growth and relative to the risk-free rate or GIC rates. I think those are simple things to look at that you should look at on every company that you own.
I think those are some great ones to highlight. We often hear a lot about earnings, but that revenue growth rate is a good one to pay attention to as well. And I've certainly heard other investors, DIY investors, talk about the value of earnings yield as another metric to consider. So I appreciate you sharing those, Charles, and appreciate you giving us your take on some of these Peter Lynch lessons here. It's fantastic stuff, a ton of insight in there. We still have more to get to, but before we continue, just a quick question for our viewers. Are you enjoying the show so far? Because if you are, make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook. You can get a sneak peek at upcoming episodes we've got of Inside Investing, as well as a ton of other content designed to help build your investing knowledge. Just scan the QR codes on screen here, and you can find all that good stuff. All right, Charles, we're going to get to our Q&A in just a moment here, but I got a little fun before we get to that, okay? And we're going to bring back Caitlin Cormier for this one. I got a little trivia game for you guys, okay? Investing Greats edition, okay? We are gonna have pose to you guys a series of quotes, and you're gonna tell me which of these famous investors said it. Was it Peter Lynch, was it Warren Buffett, or was it Jack Bogle? Okay, you guys ready to play?
Give it a go.
Okay, our first one here, first question is, this quote says, "Price is what you pay, value is what you get." So who said it, Peter? Was it Peter Lynch, was it Warren Buffett, or was it Jack Bogle? Charles, first to you.
I'm thinking that's Buffett.
Thinking it's Buffett, okay. And Caitlin, what do you think?
That's what I was thinking too, but I feel like I shouldn't be guessing the same thing. But I'm going to go with my gut. Okay,
well, chalk one up on the board for both of you. It was, in fact, Warren Buffett. We could see the answer there. So good stuff, guys. You guys are both off to a good start here, okay? Now we're getting into crunch time here. We got 2 more questions on the docket here. Here's the next question. The quote goes, "The stock market is a giant distraction from the business of investing." So who said it? Peter Lynch, Warren Buffett, or Jack Bogle? Caitlin, I'm going to go to you first.
We're talking about that wordsmithing, and I feel like this, I don't know if this is a Peter Lynch, so I'm going to go with Jack. I'm going to go with C.
Okay. And what do you got, Charles?
I'm thinking Bogle as well, but it could be any of them because they all think that way. But yeah, I'm going to say Jack Bogle.
Okay, and ding, 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 you guys are right again. I hope you guys didn't look these up ahead of time or something like that. There's a lot of quotes I could have thrown at you here, but yes, Jack Bogle is the answer. So, okay, so you guys are both 2 for 2 here. This is the decider right here, our last trivia question. This is the quote. It says, "The real key to making money in stocks is not to get scared out of them." So who said it? Peter Lynch, Warren Buffett, or Jack Bogle?
Caitlin, you go first.
I feel like that's a Peter Lynch one. That does sound like something he would say.
I'm quite certain that's a Peter Lynch one.
Okay, you guys are just too good for me here, right? 3 for 3. Way to go. You guys both got the chops, or the investing great chops. We'll have to have another game here to really settle the score here because you guys are both too perfect, clearly. But here's a question for both of you guys. What would you say makes all 3 of these legendary investors successful? Like, what do they have in common that helped them get to that point? Charles, give us your take.
For me, the common thread is long-term. Both of them are complete anti-market timers. Complete. I believe, and so that's for me what stands out as the common thread between the 3.
And Caitlin, what about you? What do you think these giants have in common here?
I think for me, I always am like the quotes that they come up with are always so like empowering and moving, and it makes me think they're extremely mindful in everything that they do. That they're very they're disciplined, and they really think things through quite a bit. And I think that certainly is a testament to how well they've performed over time, and how consistently they've done well. I think their mindfulness and really kind of analyzing things and learning from it.
Yeah, I think those are both great points that you both brought up, and for me, I think a lot of it is they always took their time. to do their research. That's what I kind of took from all their experience. They always made sure that they did the legwork. Investing, you can do it fast and you can do it easy, but are you going to do it right? It's kind of one of those things. I think they always made sure that they did their research and they knew their stuff before they got into any kind of investment. And I think that's a great lesson for investors to follow as well here. All right, guys, I appreciate you guys playing along with our trivia game. We're going to have to do a tiebreaker at some point, okay? So I'm not letting you guys off the hook that easy. But Caitlin, thanks for playing along. We're going to see you next episode. Appreciate you tuning in here and joining us here.
Thanks so much.
All right, and Charles, now it's time for our live viewer Q&A segment here. Are you ready to hear what our audience wants to know more about?
Sure, let's go.
Okay, we have a question here coming into us from Alistair. And Alistair is saying, how does one manage stop losses when holding a stock that may go up by 10x, or at least they think that it would? What do you have to say about that, Charles?
So for me, I'm not a believer in using stop losses. I'll tell you why. It doesn't necessarily mean I'm right? It's my opinion, and it's worked for me. But, having lived through some pretty major drawdowns, in my career, I've lived through 3 recessions. The first one saw in 2000, saw the S&P dwindle by about 49%, if I remember correctly. The next one in 2008 was about 57%. And the following one was COVID. That was a pretty quick and easy one, but it was still about 36, 37% drop. I'm talking about the S&P 500, and I'm using memory here, so I might be off a little bit. But if I had stop losses in some of my 10-baggers, I would have sold most of those. Realized a ton of capital gains. And would I have been wise enough to buy them back lower? I think I probably would have bought them back higher. So I feel stop losses are a way to force you to sell out of things you should otherwise be keeping. I'm really, as you can tell, I'm not a big believer at all. As a matter of fact, I think stop losses, with my philosophy of long-term investing, now if you're a trader, it's a whole different thing. But if you're a long-term investor, I believe stop losses will really hurt your rate of return.
I think that's a great thing for people to consider there. So keep that in mind, investors. You got to keep some skin in the game, right? If you want to be a long-term investor, you don't necessarily want to exit out at the first sign of trouble here. So a great point, Charles. Appreciate your perspective on that. We got another question here coming from Menno. And Menno is asking, is it wise to buy companies with a high net revenue retention? This is a new acronym for me, by the way. I had not heard this one before. It seems these companies can raise prices easily and often have a wide economic moat, competitive moat. I tend to look for such companies in the early stages of their growth, but they're hard to identify that early. Yeah, certainly. What's your take on this question, Charles?
So if I'm understanding it correctly, it's companies that will try to auto-finance themselves instead of using third parties. So basically keep their cash flows to themselves to increase in further growth, to invest in further growth, which is a much less expensive way to invest, right? And I know Buffett has spoken about this quite a bit from memory, that he finds it ironic that a company would pay a dividend, then issue a bond to borrow money to invest in a project. Why would you pay a dividend and now pay a third party a commission to borrow money that you just gave away? Wouldn't it be better to just keep the money, invest it in your project, not pay a third party a commission? The answer is yes. So in those kinds of scenarios, companies are paying dividends for appearance sake. And I hate when companies do things for appearance. I would rather they did them for the right reason. So if I'm understanding your question correctly, I love companies that self-finance their growth as much as possible and use our capital as shareholders wisely and spend less time window dressing. I think that's what I would do if I were the sole shareholder of a company. So I wouldn't want a company to do differently just to make things look better. Mm-hmm.
Yeah, and I think another thing for investors to keep in mind here is that dividends are not free money, right? This is just part of the total return just being parceled out here. So great point there, Charles. We have another question coming to us from Amy. Amy saying, wow, Peter Lynch's returns are impressive. Yeah, you can say that again, Amy. But surely he made some mistakes, right? So are there any that we can learn from? Yeah, Charles, is there any mistakes that you can think that Peter Lynch made that could be a nice jumping off point for conversation?
None come to mind. I mean, I haven't read the book in a few years. But I'm sure he went through. I remember in the books, the two books that I read, One Up on Wall Street and Beating the Street, he definitely talked about some success stories, and they're the ones that I remember the most. I can't remember if he talked about ones where he had lost on, but I would say, just judging by what he says to stay away from, is probably speaking to lessons he learned the hard way. So I always remember, if I had to sum up Peter Lynch, like in one sentence, what is it again? It's know what you own, know why you own it, and know why you'll eventually sell it. I think those three phrases in that sentence sum up for me what made Peter Lynch good. So know what you own, right? Buy companies where we talked about earlier, it's kind of easy to understand the product and why the product is good and why there would be a need for that product. Know why you own it. You know, what are you? I think that speaks to price. That speaks to what the potential growth rate is. I think at this point you're looking at how this could work out and all the fundamentals. And the last part, I think we haven't spoken about today, but I think we spoke about how Lynch is really good at hanging on to 10 baggers long enough. But from my memory of Peter Lynch, he always knew what would be the reason to sell a company. I remember that, and I think you should know that. You should, every company you own, what could go wrong with this, and then keep an eye out for it. Some things that I keep in mind, which are pretty important, and this is going into other people's sayings, but I believe the Dow Jones Index was created in the 1920s. And I think the only company that's still alive out of those 30 companies is GE. All the others don't exist anymore. Either they were bought out or they went under. I believe the biggest company in the world when I started in the industry was Eastman Kodak. I can't remember who said it, but I believe this, that the companies that are huge right now and that have been big winners for me or you in your portfolio, you want to hang on to them to squeeze the most you can out of them. You want to prematurely sell and pay too much taxes and limit your gains. But I think you have to realistically think that in 20 or 30 years, they may not exist anymore. It's kind of crazy, right? But if you go back in history, I mean, how many companies overtook the Royal Bank as the largest market cap in Canada in the last 25 years? And you can think of, definitely BlackBerry was one of them in the early 2000s, I think. It's not much of, it's a shadow of what it was, right? For the reasons we all know. There were a couple of others, I can't remember right now because they're not really memorable companies. So I think that last part of know what you own, know why you own it, and know why you're going to sell it. I think that last part we haven't spoken about very much today, but it's something to think about.
There are so many great Peter Lynch lessons here that we could pull from. We'll have to do a part two. I think that's a wonderful way to wrap the conversation, though, thinking about how do you get out of an investment there. And that's, I guess, a good moment for us to get out of the show here. But anyway, Charles, thanks so much for joining us. We really appreciate you taking the time to chat with us. It's always a pleasure. And yeah, we'll have to have you back for a part two.
Absolutely. It was a lot of fun, Robert, as usual.
Okay, great stuff. Thanks again. And for those in our audience, thank you for joining us as well. We appreciate you tuning in here. Make sure that you check out next week's episode as well, too. We got another good one here. We're going to find out if gold really glitters as an investment during times of market volatility and uncertainty like we're seeing right now. It recently hit an all-time high. Can it keep going? Will it continue to shine? We're going to have Bart Mellick from TD Securities. He's going to share his take, and we're going to hear about an interesting gold product offered by the Royal Canadian Mint. So make sure you check that out. That's all the time we have for today's episode, though. From everyone at Inside Investing, thank you so much for watching, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.